fairly tough last 40 days where we've seen stocks really sell off on several occasions. And this week has been a doozy. We had a really terrible day yesterday. No other way to describe it. It's just horrible. And I wanted to take a look at what's going on in the market. I'm seeing a substantial sell off in technology. I'm not breaking any news. And I'm seeing a rotation into some other stocks and other sectors. So I could point that out. I'll have some opening remarks, and I'd love to go over some stocks that you guys want to cover. I see NKiter is on, and NKiter, you'd like to look at a couple of stocks. So LDOS, VCTR, and then TW. Cool. Glad to do it. Take a look at those. Kunal Sharma, thanks for joining. You want to take a look at Siemens? You can look at Siemens. They're probably doing well. And Doomy Trash, how you doing, man? Good to see you. Shadow Guy. No ESPN headset. No, not today. I'll put the analyst headset away. Omar, any oil stocks? Omar, I'll talk about oil a little later. I'll give you my comments there. Hyper Wizard, how you doing, man? You want to look at Wix, the creator of websites? Yeah, we can look at it. I've looked at it over the last 5 years and never really bought the shares. So we'll take a look. All right, so let's take a peek at markets, see what's going on. The NASDAQ, if we look at the year to date, we're down 6.43, but if you look at the move that we're on, we are right there knocking on the door of a correction for the NASDAQ. And we did touch correction territory, I think a couple of days ago. It was intraday, didn't close at that level, but we've touched 10%. 10% officially isn't a correction. So the NASDAQ is right there. I'm fairly sure the Russell 2000 is already in correction territory. And the S&P is faring a little better, but it's down more than 6% if you measure the same time frame, February 19th. So that's been roughly, 2.5 weeks, and we've seen a very, very substantial move. I think part of the mindset on Wall Street is it doesn't matter that NVIDIA had terrific earnings, and I've been a short seller of NVIDIA for 9 going on 10 months. Okay, so consider that the source is, I didn't think NVIDIA was worth the stock price. I still don't. I was really impressed with their earnings. And I'm like, man, why is the stock selling off? If any stock deserves to rally, it's NVIDIA off of those earnings, but the market sold it off. And I think the market's beginning to have some disbelief in the whole AI story. Now, is AI going to be something in the future? I think it is. I think it absolutely is. But what it isn't is a money-making business for shareholders at this time. It's a big idea. It could become something humongous, but it hasn't done so. And I don't think it's going to be anything of substantial size in 2025. And as investors invest and they're looking at, hey, what's the future cash flow of this company? Let's say a Google Alphabet, which is a stock I own. Well, if they're spending more money on that data center and spending capital expense, taken away from the free cash, it changes the forecast of free cash and it reduces the value of the stock. When you reduce the value of stock, investors have a different valuation of your business. So no giant surprise, Google sold off. So Google year to date down 8.52 from its recent high to where it's at now. It's down 16%. Coincidentally, they announced earnings. They said, hey, we are going to spend so much money on that data center because AI is this big giant thing that everybody's chasing. All right, well, maybe everybody wants to chase it, but Investors want to see that their investment's going to do well. The other big story is, I think we're headed into, or we're knocking on the door of a recession. And I don't want to talk about why, who, what, when, and where. It's just a fact that the economy is slowing down. We're seeing the confidence level go down for consumers. We're seeing more job losses and headlines of companies laying people off. Of course, the U.S. federal government's laying off a bunch of people. Well, I think that's going to have the biggest impact on stock prices is going to be a recession. Once we get into a path of, yes, a recession is coming, or a recession is here, or a recession's upon us, then investors are going to be like, okay, I got to go to safety. And they'll continue to buy consumer staple stocks as well as other safety stocks and go away from these high growth companies. Now, in a way, I think that some of these stocks that have been selling off, I think it's a good thing. I'm going to look at AppLovin. They're down, I think, about 50% from February 14th, 49%, excuse me. And this is a terrific business. AppLovin is a terrific business. They do software that helps people that market online just market better, probably have better ROI. The stock price just got way too high. It's like, yes, it's a good business, but it's not worth, their market cap's 87 billion, nowhere near that amount. It's not worth that. Their revenue's tiny. Their PE is 57 now that they've reduced their stock price by 50. This is a young, small software company. A lot of things can go against them, and I think the investors now, hey, let's take the gains and get out of AppLovin. Let's go run to safety for a little while, maybe a year or two, who knows? But stocks like these, I think it's healthy to see those pullbacks. It was unhealthy to see stocks just take off like this one here around August 2nd, 2024 to February 14th, 2025. It was up 642%. It's just, that move is so euphoric. It's frothy. It's artificial. It's unbelievable. All those, put whatever adjective you want. And when you look at the valuation of AppLovin, you're like, guys, this is a terrific business, but it's not worth, the stock price that it's trading at. And it's going to end, painfully for those that bought at high levels. And then they're going to realize, wow, stocks don't go up forever. AppLovin was not going to be a $10,000 stock way up here. It just wasn't. It's, you gotta, in my book, I base decisions on principally on valuations, value companies based on the future cash flows that business is going to produce. Benjamin Graham wrote his book about 100 years ago. That's what he said. And a lot of investors have followed and said, yeah, that is the true measure of a business value, is how much cash could be produced. And you can break it down to simple terms. You can go really complex. At the end of the day, that's what it's worth. And AppLovin is a terrific business. It does drive, free cash flows, but nowhere near the stock price that it's at. So this correction's good across AppLovin and probably, 40, 50 stocks. Semiconductor has just been getting hammered, and for good reason. I think a couple of stocks that announced where NVIDIA, of course, went down in stock price, that really got pushed down. And again, I'm beginning to believe, and here's some stocks that have been trading down on semiconductor. And for the year to date, you're seeing that, NVIDIA, Broadcom, TSM, AMD, they're all down, and they're down from their all-time highs. If you measure that, it's even worse. So all these things, it's a good thing to look at stocks that are really frothy and way overpriced, and see those prices come down to intrinsic value. Now, stock market tends to, overshoot the mark. It depends how bad this correction is. Now, I'm not like a super bear, a pessimistic person. I'm actually very optimistic. But I just want to give it to you like I see it. At least you get a point of view of what's going on. When we experienced 2022, we had a situation where stocks just kept selling off, and we had moves similar to the one we're experiencing. We had really down moves, and NASDAQ, just using that as an example, really sold off. A lot of these high growth stocks sold off. And in some cases, the market was just irrational to the downside. Now, I say that because we're not even close to that. Okay. So let's just use this as kind of, we'll see if this happens, but it may not. So our friends at Netflix, right? The market said, oh, it's time to sell growth stocks. Netflix is a terrible business. Let's sell it off by 74%. It was a great opportunity by Netflix. Oh, stupendous opportunity. The market overshot the mark on Netflix, and it was a great opportunity. We're nowhere near kind of like prices here. I showed you Google Alphabet. I think Google Alphabet may have more downside. It's like the stock price is where it is, but I think it could go down further. And maybe at some point, Google Alphabet may look a little more closer to this example. I'm pretty close to beginning to buy Google Alphabet shares. I own a lot of it, and that's probably the principal reason why I'm not buying into Google Alphabet. If I didn't own any Google Alphabet, I would be buying Google Alphabet. But these situations are going to present themselves if we continue on this sell-off. Right now, we're just knocking on the door of a correction. No big deal. But the story of the recession, that could take us from NASDAQ being down 10 to the NASDAQ being down 25. And a recession is really hard to get over, because the recession is going to really impact the whole sentiment of the consumer. The consumer is a big part of the economy. Well, that then it's just continues to knock over dominoes. Then a bunch of stocks get hit because people aren't buying stuff. They're not upgrading their iPhones. They're not upgrading their TVs. They're not going on vacations because they just want to hold this thing, wait this thing out, wait until the coast is clear, the economy is better, and then they can start spending some money. So that's where I think the market's at. We've seen a good rotation. One positive thing that I see is, as we see, the best performing sector by far was technology. They won like every contest over the last couple of years, and it was a good place to be in technology. And now it's giving up some of those gains. I don't think it's a big giant problem. If you're sitting on huge gains, oh well, you lost it a little bit, no big deal. But I think that money is rotating into healthcare, materials, and real estate to some extent. I don't like covering consumer staples because that's purely a safety play, and I don't like consumer staples. They don't perform over time up to the levels of performance that I want out of stocks. If I want stability, I go to bonds, and bonds are super stable. They give me about the same rate of return as staples, but without the risk. So anyway, so back to healthcare. This number, the 5-year return, is really impacted by the poor performance we've seen over the last 2 years. But I've invested in healthcare companies for 20 years, and I've done really well with healthcare. Now I'm looking at healthcare thinking we're starting with very good fundamentals, low PEs, very good free cash flow generation, very good discounts based on intrinsic value of cash flows. And I think the money is rotating into healthcare, and Healthcare is a pretty big, sector. It's $8.1 trillion. We go into a recession. Healthcare does good in recessions. We still go to the doctor. Doctor says, go take this medicine. We go to the pharmacy, pay our copay, get the medicine, take it. If one of our kids or somebody we care about gets sick, we go take care of them. So that stuff is going to be okay in recession. So healthcare is looking good. It's $8.1 trillion market cap. Technology is massive, close to 20 trillion. Consumer discretionary is number 3. So it goes technology, then healthcare, then consumer discretionary. So a lot of money can move to healthcare. And I was checking out Michael Burry's portfolio, the big short guy. And I've got that queued up. He's big into 2 things. Michael Burry is betting big on China, and he's betting big on healthcare. Like 80% of his portfolio is China, number 1, healthcare, number 2. So big investors are rotating into healthcare. So I've been rotating into healthcare. You guys that come to my channel and watch my live streams and watch my videos and the paid investor call we do on weekends, I always, share what I'm doing with you guys. And you guys know that I've been going into healthcare. So far, so good. Healthcare is up 8.55% year to date. And I'm going to keep rotating. Yesterday was a fairly big rotation day. I bought a lot, for me, right? I'm a dollar cost average guy. And I bought healthcare stocks yesterday. That was the biggest buy that I had yesterday. And I probably put a lot of money into the market yesterday compared to other days. I just saw that, the sell-off was pretty intense. And I bought and really increased my healthcare position. I'd like to continue to do that. I want healthcare to be a bigger part of my portfolio. It's a good size, but nowhere near the other sectors. I own Meta and Google Alphabet are my top 2 positions. Those are all part of communication services. And this is doing okay because Meta's still in the positive for the year, even though the last month has just been horrible for Meta. And, hey, awesome. They're good companies. They're not going anywhere. They're staying on my portfolio. But that's my biggest sector, biggest concentration, I should say. And then technology is huge in my portfolio. I probably have about the same amount invested, but across different companies in technology. And I have a lot of small caps in there too. And then probably number 3 is financials for me. And that's done really well, especially insurance has done great. Insurance is going to do well here in 2025. It continues to do well. And, after that, it's probably healthcare. Now, I would like healthcare to take over my probably the 3rd biggest sector in my portfolio. I think financials is good. It's not going to be great. Banks sold off big yesterday. Big move in banks. I'm sure you noticed it, but banks had a hard time, and because of recession. If you have less economic activity, banks don't lend as much. Businesses don't go to the bank and say, hey, I want to start a new business. Hey, I want to expand my business. Hey, I want to hire more employees. And banks are like, hey, we don't get to charge fees. We don't get to lend money out and make money. So those things are happening out there. It's super interesting year. It's been a super interesting year. It's been, I'm still in the green for the year, which I feel like, man, that's pretty cool. I'm beating the market. I'm up about 0.8% while the market's down. The S&P's down pretty good this year. So I'm going to try to stay in the green for 2025 and beat the market and have a positive rate of return here in 2025 as we rotate away for things that really worked over the last 2 years to things that are going to work over the next couple of years. So that's what's going on out there. Let's look at the big giant caps. So Apple is a safe place to go. A lot of people feel safety in Apple. It is the biggest market cap. And it is pretty amazing that it always kind of tends to Keep it together. Microsoft down a little bit year to date. Nvidia down substantially. Amazon down, and Amazon had a horrible day yesterday. Google Alphabet down, and I showed you that really the move from the high to the low is 16%. So it's not like it's just 9%. It's pretty more dramatic. Meta went from being positive 25 in January of 2025 for year to date, just for the year to date, down to 7.25. So this thing's just been getting beat up, down 4% yesterday. I mean, look at this red on every stock. We have to go way down here to ExxonMobil. And Tesla's just been getting smoked. Broadcom, I think it's up today. We'll take a look a little later. Maybe when the stock market opens, we'll look at Broadcom. I'm not convinced the stock's going to rally. I looked at the earnings. I reviewed them very carefully. And I understand Broadcom really well. I was a Broadcom stockholder. I made money on Broadcom. I sold Broadcom. And I'm in disbelief at the current stock price. We can take a look at that one if you guys want. Eli Lilly moving up the charts, up 18%, healthcare. And then we got some financials. But you see, some of these stocks are really moving down, and we'll see which ones move up. I don't think we have many earnings reports today. Let's take a peek. Oh, Berkshire. Never heard of that company. We'll see what they announce. And then I'm not familiar with these other companies, so not a lot of news out there. All right, so let's get cracking on some of these companies you want to look at. Let me catch up on comments, and then we'll go from there. So we left off on Wix, and then Mike, the dividend investor guy. Good morning. Any thoughts on BAH? Yep. I can cover that. And then United Therapeutics. I can cover that as well. And then you got a question, CODIS on CRM. I can cover that a little later. Rotel and Cheese, good to see you. Is there better opportunities in foreign markets like Europe, UK, even India and Brazil? So I could later on talk about foreign investments. Foreign being, I'm in the US, so investing outside the US. We can cover that. Zhao, good to see you. You want to look at international or IB Interactive Brokers. IBKR. Okay, cool. Mohammed, good to see you. You want to take a look at Amazon? Yeah, Amazon's been sold off, man. No news to anybody, right? Shadow Guy. Oil. You still like EQNR and Exxon. Yeah, we can look at those. Let me note those. And Mike, the dividend investor guys liking the EQNR. Cool. Magical Self, NVO in healthcare. Please offer your thoughts. Yeah, we can look at NVO. And then insurance. We can talk about insurance. All right, so let's get into it. I'm going to prioritize. We've got some paid investors on the channel. I really appreciate your support of the channel. And I'm going to cover your stocks first as a showing my gratitude for your sponsorship, and then we'll get to the other ones. So, Kiter, let's take a look at LDOS. So Leidos Holdings, together with its subs, provides services and solutions for government, commercial customers in the United States and internationally. The National Security and Digital segment provides national security software, services by using artificial intelligence and machine learning to coordinate sea, ground, air, space to help warfighters, offensive, defensive, and physical cyber operation solutions, intelligent analysis, operational support, logistics operations. Wow. Interesting. Okay. And they're put into the technology sector. Let's take a peek at their website. So, okay. So they're kind of aerospace and defense, but with the technology product line. Okay. All right, got it. So the company over the past year is not done great, especially from November 11th to now. It's really had a hard time. And it hasn't broken any records on appreciation over the last 5 years. It's only up 23%. Not very good. Very low PE. That looks like a good PE. Market cap's nice and low. It's 17.45. Revenue is almost, 1 times. Very good. Analysts say it's a buy and it's discounted. So when we look at their revenue growth is consistent. That looks really good. Okay. What kind of margins are these guys operating with? Very low margins. So when you do business with the US government, they tend to want to know how much money you're making as a company. And they tend to hold your margins nice and low. If you look at aerospace and defense, that's what you're going to find. And so that's a really low gross margin. If you told me, hey, we're going to look at a company that's in technology and they do software, I'm immediately thinking, oh, they're going to have margins above 70%. So this is a different situation. Okay, so it's a low gross margin rate. Now, when we look at free cash flow, it's 1.2 billion for the trailing 12 months, and that is a full completed fiscal year 2025 because it finished in 2025. They're calling it 24 on stock analysis. Okay, so the business is growing well, single digits, but it's pretty good, pretty decent growth. The margins are not great, but they are generating free cash flow. So I would say that if I would multiply this times 15, that gets us to about $18 billion of market cap. And when I deduct any kind of debt they have, then we'll get to what I think the market cap ought to be on this stock. So they have about $4.47 billion of debt. So I would say this business is worth about $14 billion in market cap. And they are 17.45. So this one's a pass for me. I can find a lot of stocks that are in technology that can perform far better right now, like at this moment. And obviously the market is not liking their margins. It's not liking overall the value of this business. So those are my comments there. And Kiter, we have terrific technology and it's coming down in price. I mean, some of these stocks are just getting hammered. If you want security stocks, of course, Zscaler had a pretty good day when they announced their earnings. Even though the market sold off drastically, it was still up 3%. It's up in the pre-market by 1%. We've covered Zscaler among others. I think you like, I forgot the stock that you like in cybersecurity. But this one here, this one hasn't been bid up like a CrowdStrike. And therefore, that was kind of like the beginning of my interest is, hey, I don't want to buy a stock that is like the AppLovin. Terrific company, but everybody wanted it. So the stock price is way up there. It's like, no, thank you. This one here, it's a little misunderstood. Like, why does the market not like this stock? But now it's beginning to warm up to this stock and say, hey, there's some value here. It's a low market cap. It's growing really well. I mean, look at this growth. How about your margins? Show me some margins. How about 78%? Yeah, that looks pretty good. So this one here is one that's beginning to work, and I think it's got some good upside. So anyway, back to LDOS. That one's a pass. Now let's talk about VCTR. Victory Capital Holdings. Victory Capital Holdings, together with its subsidiaries, operates as an asset management company in the U.S. and internationally, offers investment advisory, fund administration, fund compliance, fund transfer agent, fund distribution. Okay. So asset management and financials. What's it been doing year to date? So financials have been selling off. So if we get into recession, right, investors are going to be like, you know what? I don't want to take any chances for the next couple of years. I may not have a job at the end of the year. If you're a business owner, you're like, may not have a great business year in 2025. So I think the expectation is there's going to be lower interest in investing is kind of like a high level assumption that I'll make. This company does have a really low PE. Let me check something. So over the 5 years, this thing's done great. Over the 1 year, it's done terrific. Really low forward PE. That looks terrific. And they pay that dividend. As we get into recession and we go, investors would want to go to safety. Emotionally, psychologically, dividends look great. When all other stocks are selling off. Like today, Pfizer paid a dividend. Pfizer pays like a 6% dividend. So I'm being paid $675. So I woke up this morning and my computer told me, hey, there's $675 added to your account, thanks to Pfizer. That feels pretty good. It's like, I got my, handed to me yesterday, and I'm a long-term investor, right? So I'm kind of kidding a little bit. So to have dividends in a down market, it's a pick me up. It's like, you know what? Okay, everything else is maybe crashing and burning, but it felt pretty good to get that dividend from Pfizer. I don't value companies based on dividends, by the way, but it's just a positive, especially as we go into recessions. It's just a positive. So I see that as a positive there. This is a tiny cap, $3.68 billion. The revenue is $893 million. And their growth is not impressive. It's okay. And let's take a look at the quarterly. So in Q4 of 2024, right, we had a Republican president elected, which is a big, positive for stocks, positive for investing, positive for wealth creation, because especially Donald Trump, he's more of a pro, hey, let's make it easier to make money. But now as we enter into the first quarter, the things have changed substantially. It's kind of like, oh man, we got these tariffs. The tariffs could be disruptive. If anything, they just create a lot of noise, a lot of tension, and that fear and reduction in sentiment is affecting the economy. If we have people losing jobs and so forth, where I'm leading to is I would not be surprised if we're sitting here when they announce earnings, which will be 3 months from February 6th, which will be May 6th or so. If we're sitting here looking at the quarterly and we see a negative number because people pumped the brakes, they halted their investing. They're like, hold on, I don't want to put more chips on the table. I actually want to take some chips off the table. Victory, I want you to manage less of my wealth. So that could start happening. And that's one of the things that I would be careful with is this stock has run up over the last couple of years nicely. If we are in a really good correction slash, maybe even worse, this stock's not going to do well. That's just you probably knew that. Their free cash flow is good. You can substantiate that market cap very easily. If you think they're going to be a slow grower, no grower, the stock's worth their market cap. If you think they're going to be a fast grower, like a Robinhood, this thing's discounted. But they got to start growing. This is not growth. And they're really small. It's not like they're gigantic, so growth is hard. No, you have to start growing. Because if you're not growing, then your competitors are growing and taking away market share from you. So stocks priced okay. Let's see what analysts, I don't think they shouldn't have much debt. So they have a little less than $1 billion of debt. So 858 million. Okay. 9 analysts cover the stock. The bullish analyst is at $82 stock price target. And then the worst case scenario analyst is at 59. So now these price targets probably created, a quarter ago when we were in a go market condition. Like, oh man, market's going to fly up. So this one here is a pass for me. It's a wait and see for me. I need to wait and see what's going to happen. The market's, basically saying these guys could begin to struggle. And I think the struggle could be a long-term issue. For me, I would want to wait till I see Q1 of 2025 earnings, and I'd want to understand what the business is doing, what they're doing to navigate the market conditions we're in, and then monitor the economy. Like, hey, if we truly are going into a recession, this company's not going to do well. These guys make money when people are feeling optimistic, bullish. Hey, I want to put more money in the market. Hey, I want you guys to manage this. I want you to manage that. If things are tight, they're going to be like, okay, I got to preserve more cash in my savings and checking account. I don't want to take a lot of chances right now. I want to stay out of stocks. So that's what's going on there. Thanks for asking about Victory. Good luck. TW. Tradeweb Markets. So these guys are doing okay for the year to date. Nice for 1 year. Terrific for 5 year. Forward P is 39. So Tradeweb Markets, together with its subs, builds, operates electronic marketplaces worldwide. The company's marketplaces facilitate trading in a range of asset classes, including rates, credit, money markets, equities. Seems like a really interesting business. Interesting. Okay. So Tradeweb, capital markets financials. Okay. Now these stocks have been doing really well. All these exchanges and so forth. These guys have been doing terrific for the last 5 years, and they're really holding their value well. $31 billion in market cap. Revenue is 1.72. PE is 39. It's a strong buy, but there's no discount. Revenue growth is really good, and especially this year that they just finished, 28%. Wow, that looks great. And the quarterly shows 25%, the most recently closed quarter. So very good growth. Something's happening. You see how their growth went from 12.5% to 28%. I would double check to make sure it wasn't an acquisition. Not saying acquisitions are bad. It's just not as good as if they grew organically from 12% growth rate to 28%. That means their customers love their product. They these guys can raise prices. There's demand on their product, very good demand. That looks like a solid number. Free cash flow looks really good. And where's their margin lines? So their operating margin's 40%. Profit margin's 29%. These guys are really profitable. Looks really good. So based on their growth rate, if you feel confident with the growth rate, I mean, we can multiply this times 30. We'd get to 25 billion, 26 billion minus debt. They have no debt. So they have $1.3 billion of cash. So take 25, add 1, we're up to 26 billion. They're a $31 billion market cap company. So there is no discount available on the company. For now, it'd be a pass for me. I'd like to see a nice strong pullback. You see, like in 2022, these guys are following the value of the exchanges. If the exchanges start to sell off, they see lower volumes, they're less trading. So if we get into a really solid correction, these guys are going to go down. And it might be a good idea to watch this stock and, buy it when it pulls back, because right now it's priced, I would say, close to fair value, maybe a little expensive, not overly expensive, 10, 20% too high. The stock is covered by 13 analysts, and the best case scenario, price target of 155, worst case scenario, 122. It's a pretty tight range of price targets, and it's being discounted just a tiny bit. So these analysts put together their forecast, but I think the forecast is kind of hard to believe right now because things change so much from Q4 of 24 to Q1 of 2025. Just the environment's very different. So this one here is quality business. Quality business. It's just priced a little too high. All right. BAH. So we've looked at this one a couple times. Booz Allen Hamilton provides management and technology, consulting, analytics, engineering, digital solutions. So these guys are, I believe, professional services. They have 34,000 employees. Okay. And let me just confirm that my memory has this company correct. So yeah, I think that's what it was. Professional services. So consulting services. Okay, cool. Now, consulting services are not as profitable as like software. These guys may help you implement technologies and software, but they have to hire really educated, valuable, intelligent people. So they have to pay those people. So it really takes away a lot of the profit. So it's a $13.7 billion market cap company, $12 billion revenue. They've been growing nicely. Now, consulting, I'm really worried about in 2025. If we have a recession, businesses are not going to hire this firm to do a lot of work. They're going to be like, no, we got to hold off on projects until we have a better economic environment where we feel like we're going to make lots of profit. Right now, we're being asked to reduce our expenses. So we don't want to spend too much on consulting. 14%. The quarterly looks good. Again, that's a quarter that ended December 31st. The environment has changed dramatically over 2-3 months. And when we look at these guys, I think when we look at free cash flow, looks okay. Gross margins are low, as mentioned, professional services. So based on what I expect out of consulting for 2025, this business is maybe worth $10 billion. And that's assuming they don't have any debt. They do have $3 billion of debt. So really it's worth about $7 billion, and they're being priced at $13 billion. So this one's a total pass for me. I don't like businesses that have low margins. If I'm going to touch technology, I'd rather go after a high margin business and go get that software company that's, has 80% margins. This one here, I don't know that it's going to do great over time. It's done really bad over 1 year. This might tell us that the economy, or I should say, the market's saying we're going into a recession and consulting companies are going to sell off. That's what that chart tells me. I don't know what it tells you. Over the 5 year, this is done okay, but I'm not looking for okay. I'm looking for over 5 years, it's 100%, 200% rate of appreciation, if not higher. So this one is a pass for me. United Therapeutics. That United Therapeutics is not a pass for me. I've been buying United Therapeutics this week. It's been selling off. Over the 1 year, it's up 34%. It's had a pretty good pullback. It's a $13.8 billion market cap company, $3 billion of revenue. PE is 11. Now, 11 PE, they have no debt. They actually have a bunch of cash on the balance sheet, and they're growing by 23%. That doesn't fit the situation. 11 forward PE and a very high growth rate. 19.7 the last quarter. So you have a high growth company on a pretty substantial number. We're getting close to $3 billion of revenue. Their margins are terrific. 89%. What's there not to like on 89% margins? The next unit they sell, they would spend 11 cents and the customer would give them $1. Incremental cost would be just 11% to get $1. Free cash flow rate, look at that margin, 37%. This is a really, really strong, fundamentally strong business. They don't have any debt, if my memory serves me correctly. They have $3.2 billion of cash, only $338 of debt. So no, they have a lot of cash on the balance sheet. So this one here, curious to see what analysts are saying. 12 analysts price it. Some analysts are like me, just love the company. $600 price target. Low, worst case scenario, it's going to drop down to 280. Not too bad. It's discounted by 26%. Collectively, they're saying the business is going to continue to grow. This year, it'll grow by 12.5%, then 6, then 8, then 7. Those are good growth rates. As they get bigger, it's going to be a little harder. Now, are these guys recession proof? Yes, because these guys create treatments and drugs for these rare diseases where these people, unfortunately, they have this condition, and their drugs really work. Their drugs really work. So if somebody's unfortunately gets this condition that United Therapeutics treats, it doesn't matter if they're employed, unemployed. It doesn't matter if they have, $10,000 in the bank or $1 million in the bank or $50 million in bank. They're going to buy the drug that's going to help them, because it's game over if they don't. These are really bad diseases that these folks have. So it's a good thing that United Therapeutics has invested the money to create these, treatments, and they're going to do well no matter what. I'm buying into the stock. I really like the stock and think it's discounted. As you guys know, I'm in United Therapeutics, so I have a valuation on United Therapeutics. I think it's discounted collectively by 94%. So I'll buy more shares, and I will gladly buy more shares. This is the type of business I'm looking for. Thank you very much, stock market, for the discount. So that's my review there. Let's talk a little oil. So we're going to talk Exxon and then EQNR. ExxonMobil. It was up nicely yesterday. It was one of the few green stocks yesterday. It's up today a little bit. Stock oil prices have been relatively low, right? They're trading oil's trading in the 60s, high 60s. It's a big cap, nice forward P of 14, nice dividend. This dividend's solid. It's not going to go down. And over the 1 year, it really hasn't performed. This has been the oil industry has not done well. 2% appreciation plus your dividend, you're up to 5-6%. That's just not getting it done, especially on a year like 2024 where, man, appreciation rates are really high. But this one here could be a nice safe stock. I don't think oil is going to go down any further. If anything, it's going to catch a rally. And if that commodity price goes up, so will Exxon stock. They're going to grow with the commodity price. If commodity price is up, it's going to go up in revenue. If it goes down, it's going to go down in revenue. So that one there is just a situation. The oil industry is oligopoly. It's an oligopoly. There's like 6 players that control 95% of the market. And globally, just about. So these guys are the biggest player. Pretty safe stock to be in. Tremendous free cash flow. Just massive amounts of cash. So that dividend is nice and safe. So this one here, I own Chevron. I'm not going to buy Exxon. I can understand an investor owning an energy company just to diversify into energy. Totally get that. And you get that dividend. So Exxon's a good quality business. When we talk about oil, you got EQNR, which is in Europe. I believe it's in Norway. Norway does have a lot of reserves. It's up nicely in the pre-market. It's much smaller than Exxon at 60 billion. Yeah, forward P of just 6. This is a good company. The thing that I don't like about EQNR is that it's partially owned by the government and the government's involved, and nothing to say about, the country, nothing bad to say about Norway. I imagine they're just great people and their government does a good job and so forth. But I just don't like the idea of government is involved in my stock, in my company. Just the reality. That's my preference. Somebody else may feel different. These guys do have the government as part of the company. They pay a whopping 10% in dividend. Part of it is that the stock has been going down in price. Over the 5-year, not bad, but especially if you consider at this dividend rate, you would have paid 10% a year. Geez, man, you would have really accumulated a lot of cash, a lot of income. That dividend is going to be safe. I mean, it's these oil companies, especially like EQNR, they have the reserves in Norway. They already established the extraction of the oil. So it's just kind of flowing and people are consuming it and these guys make money. So that's what the industry's about. Both stocks, I can't argue with somebody wanting to buy them. If you really like EQNR, you really like that higher dividend rate, I can understand that. If you really like the name of Exxon because it's a super big company, really safe stock, totally get it. Take your pick. If you want to be in energy, you have good choices because the energy markets are not doing great. So in my opinion, it could only go up from here. If oil prices were to go up, let's say 20%, this stock is going to fly up. Now, I don't know if it's going to go up 20%. It could, but if I don't think it's going to go down much further. It's just hard to believe that it would go from like 65 to 55. That'd be really low. So thanks for asking about EQNR. All right, somebody asked about Siemens, and let me just catch up on comments, and then we'll get into Siemens. So Rotel and cheese, you like RTO? Put that on the list. Abdel, very good to see you. Thanks for joining. Shadow Guy. SMB. Take a look at that. Jerry G. Lumen. All right. It's been a troubled business, but I think they may be getting their business back together. Do Me Trash, shipping stocks. Seems like shipping stocks come up a lot because they have very low PEs, they pay high dividends, and if you catch them at the right time, you can make some good money. Mike, got to run to a meeting. Good luck. Thanks for joining. Rotel and Cheese. Germany is a sleeping giant. There's no new pro-business government. Their new pro-business government is about to inject. Okay, cool. I agree. So you got a company out there, ZAL. Okay. We'll take a look at that. Jay Zev, good morning. BBAI. BBAI. I don't think I've ever looked at that symbol. All right, it's on the list. Do Me Trash. Hood sold off today. Oh, man. I thought I was having a good morning. Market hasn't opened yet. Okay, we'll see. Tomas, how you doing? Buenos dias. Sergio, good morning. So I haven't covered Broadcom. I can cover it, but it's going to take a little while. I've got like 12 to 14 stocks on the board. And then Tomas, is it time to buy Meta? That's a very good question. And then the ticker that you want is SNBN. Okay. All right. So let's take a look at those. So I'm going to crack open Siemens, and then we're going to get back to the requests on SNBN as well as Meta, and then we'll get back on the list. So Siemens, coincidentally, is going to talk about Germany because Siemens is a big German company. Let's see here. Siemens, I think this is the one we want. No, that's not the one. So whoever asked about Siemens, can you give me a symbol? Because I have too many choices here. We have Siemens Energy. So, yeah, give me a symbol, please, that you want me to look at. I got too many choices. Okay, then I'll come back to it. All right, SNBN. So this is a bank. Banks sold off hard yesterday. This one also sold off 1.4%. They have a small dividend. Wow, look at these swings in revenue. Interesting. Yeah, this income statement is got a lot of swings in it. Like it's going from big positives to big negatives. I'd have to crack open the income statement and really understand it straight from their investor page. When we look at banks, I like to look at book value and make sure that they're growing book value over time. They are growing recently, but they were a bigger bank and then they dropped and now they're up again. Man, there's a lot of their financial data is hard to understand. It's not smooth growing data. It's very disruptive. Like 1 year is negative, 1 year is positive, 1 year is negative. So I think really understanding this bank, going to their financials on their investor page, and really making sure, that you understand, okay, this is what they do for a business. And they've had some big swings in their financial statements for reasons that I understand. And I'm not too worried about it. Or maybe you understand them and it does create a lot of worrisome. So this one here, I can't really, I can't really say much other than it requires a lot of investigation. Yeah. This would be a good one for maybe the investor call, something we can crack open and kind of look at the financials and try to figure out why the numbers are swinging so broadly. All right. So, excuse me. All right. I had to clear my voice there. Sorry about that. All right. So let's talk about Meta. So Meta has seen a really drastic pullback. Now, when we talk about the Meta business, I am very optimistic about their business. In the 1 year, they're up 27%. They were cranking for a little while, and they've seen a very big pullback. The PE of 24 is very reasonable. This business is growing very quickly, and I don't think there's anything's going to stop them. 22% growth. Boom. Very good. And this is a big number. They're growing on a $164 billion business. Bam. Great margins, 81%. And their margins continue to get bigger, just slightly, but that's a lot of money when you have $165 billion of revenue. 1% is 1.6 billion of profit. It's like, yeah, 1% makes a big difference. So free cash flow is terrific. Free cash flow margin, 32%. Man, find me a bank that will pay me 32% rate of return. I will gladly deposit my money in that bank. Analysts, the optimistic analyst is at 935, pessimistic 360. On average, it's discounted by 14.5%. Meta is discounted by 44% based on my analysis of their free cash flow and their earnings per share. This is a stock that I believe is going to double in value in the next 2 years, maybe 3. It's a really good business, really good company. I own like $270,000 of the stock, maybe 250. Yesterday was brutal. So it's my biggest stock investment. And I think they're going to do terrific. I'm not going to buy shares because I own too much of it. If I didn't own shares, I would be buying Meta hand over fist. I'd be buying it. I want it to be a part. It's a substantial part of my portfolio. Biggest holding I have. So take that and make your decision. Tomas, may the force be with you. So it looks like for Siemens, it was so who asked about Siemens? Let me make sure I cover your 1 second. Let me catch up on Siemens. So it's Kunal, excuse me. And I don't see Kunal commenting. So Kunal, if you want to give me that stock symbol, I can cover it just to make sure I cover the one that you want to see. All right. So we're going to move on to Wix. Wix is a, they kind of do like websites. You go to their website and you get all the tools to create a really nice, elegant website. And that's mainly their product. Within that product set that, you can sign up for like payment methods and all kinds of stuff. What's been interesting is, yeah, I get that. They compete against like Shopify. And for the 1 year, stocks really worked. For the 5 year, not so much. It really pulled back after COVID. So these guys are doing really well for the 1 year. The stock was really priced down. The forward P is 24. It's sold off along with a lot of other tech stocks. 24 isn't bad. And the growth is good. 12% growth on $1.7 billion of revenue, and their growth is accelerating a bit. That looks really good. Looks really good. We look at their gross margin, almost 70%. It's been growing from 61, 62, 67, almost 68 now. That looks good. And free cash flow is almost 500 million. It has been growing good. So these guys are worth 10 to 15 billion less debt, and they have no debt. They have more cash than debt. Okay, good. So 10 to 15 billion dollars in value. This business is a good business. It's not highly discounted. If you look at their growth rate, their growth is growing really nice. So I might give this one another quarter. And the reason I say that is the economy is really in a different place. Like Q4 compared to Q1, it's like, hold on a second. What's really going to happen in 2025? That's where we're at. So I'd want to see that, hey, that's not affecting their continued growth. If I saw a negative number, obviously it'd be like, oh man, I'm glad I didn't buy, because they have kind of they have good momentum. I just want that momentum to continue. The stock is in a pullback. It's up a little bit today, but it's in a pullback, right? If we keep selling off and maybe Wix trades down another 10, 20%, now we're talking. And now we can kind of get a discounted stock that looks good. Maybe this PE drops down to like 20 and we're good to go. I just showed you Meta. Meta was at about this PE, but that's Meta. That's like higher margins, very well-known company. They're going to be unstoppable over the next, 5 years. So this one here would be a good stock to watch, but I got to get a better discount, and I got to see that we've kind of hit some type of bottom on these types of technology stocks. Yeah. So good one. Glad you brought it up. CRM. What's going on with CRM? So Salesforce down a tiny bit. They've been holding their own. They sold off after their earnings. But I really believe in this business. 25 PE. We just saw Wix, which was a small business. These guys are big revenue. 38 billion. Market cap 276. They are growing. Nice growth. Quarterly, right there. They have terrific margins, terrific cash flow. Look at this big cash flow number, 12.4 billion. Margin 77%. And I think that a part of what the market's thinking is, well, is AI going to disrupt these guys? The answer for me is no, not for the next couple of years. And in fact, AI may become a really big opportunity for Salesforce. We'll see. So I've been buying into Salesforce. I actually bought shares this week. I'll continue to buy into Salesforce. I think it's a terrific company. It's in a space that I really like. It's technology, of course, big margins, big profits, big cash flows. Look at those discounts. Come on. When can I buy more shares of Salesforce? I am glad to buy at the current prices. Salesforce looks good to me. And that's my thoughts on that. So somebody asked about how do I look at foreign investing versus, U.S. stocks? And the short answer is that I am interested. I'm just careful. I'm buying into China. I'm not loading the boat. I own BABA, FUTU, which is FUTU, and I own an ETF. I also own a new ETF in Germany, and I thought that was a pretty good idea. I own some stocks down in Latin America, Mercado Libre, and New Holdings. I think but 90% of my portfolio is in the US. So most of it is here. It's one of the things I want to follow is I like investing in companies that I can understand. that I can keep track of, that I can become a good owner in. Good owner meaning I understand the business. I understand when things are good, things are bad, when the company is executing well in their business plan. I understand their differentiation well, their competitive advantages well. And U.S. companies, I have a better ability to do so. I don't understand the Chinese economy as well as I do the U.S. economy, not even close. So I'm careful. I don't want to go too far. I don't understand the German economy as well as I do the U.S. Again, be careful. And same thing with Latin America. So I think it's a good idea. For me as an investor, I think it's a good idea, but I'm not going just crazy. Michael Burry, maybe I could show you Michael Burry's portfolio. So Michael Burry, of course, is the big short guy, and he's done well 5-year. And when we look at his portfolio, he's loaded up on China. Biggest holding is Alibaba, Baidu, JD. I'll show you all the China stocks. So China. So a majority of his portfolio is in China. If I add it up really quick in my head, he's got 52% of his portfolios in China. Now, this is the big short guy. He's not afraid to make a big bet. And then outside of that, he's in healthcare. Healthcare is a smaller percentage, but he's in Molina Healthcare, Oscar, HCA Healthcare. So here's a guy that he goes all the way in his investments. I don't invest like that. I invest the way that I invest. But he's a good example to kind of look at and say, oh, okay, that's how he does it. Maybe get an idea or two. If you are interested in being that type of all-in kind of investor, check out some super investors, maybe get a lesson or two out of what they've done. I think we're going to talk about IRBR. So did I write that down right? IRBR. So assuming I wrote down the symbol correctly, IRBR is a Brazilian reinsurance solutions in Brazil and internationally. Okay. Really small cap. It's not done well over the 5-year. Over the 1 year, it's up nicely. Year to date, done well. So this is really small cap. This isn't the Brazilian currency. So I think this is tiny cap because this is 3.8 of this Brazilian currency. So yeah, this one here is so out of my league, man. It's really small. It's in the Brazilian currency. I'm not going to be able to give many comments on this. It seems like a low PE. I would want to do your homework on it and understand Brazil. If you're going to invest in Brazil and you're going to go after a small company like this, you got to really know that this business is going to do well. It's a riskier stake that you're going to make. So be careful with it. As you can see, it really sold off. So I'd be very careful with this stock. Good luck with it. Amazon, the stock price has been coming down. I think it's this is one of the companies that I want to own, and it's really come back down from, it was doing really well for a while. The market again was irrational when it was selling it for 160 and I was loading up, and the stock went up and now it's back down to 200. It's a really good company. And I think the stock is reasonably priced. It's probably priced a little bit expensive, like 4%. But it's a good stock. $2.12 trillion in revenue, market cap, excuse me. They're a massive revenue company, $638 billion. It became the number one revenue company in the world, overtaking Walmart, growing at 11%. Impressive. So Amazon's a good stock. And man, if I did not own Amazon, I'd be buying it. I own Amazon, and I'm thinking I'm going to start buying it. Man, if it gets to 190, 180, I'm going to be buying it all day long. Right now, I own a substantial amount of Amazon, so I'm good to go. But it's a good stock. My valuation on Amazon, I think it's fairly priced to the yeah. Well, you're getting like you're paying a 8 cent per share premium on it, so it's fairly priced. So Amazon, awesome business, incredible. Somebody wants to talk about Novo, NVO. This one, when I look at it, it's a good business. Almost 400 billion market cap, $40 billion in revenue, 22 forward PE, strong buy, 61% discount. We're looking at a high growth company that's big. And this is in US dollars. No, this is in the Danish currency. And when you convert that, it makes these numbers more palatable. Like this is converted to US dollars. This is 40 billion. You see the revenue here is 290. That's in the Danish currency. Growth is 25%. Looks really good. These guys do one of the weight loss drugs, and it's doing really well. Free cash flow is awesome. And margins 85%. Boom. 85%. Beautiful number. These are the kind of businesses that are very valuable. This is healthcare. That's why I'm excited about healthcare. These are the kind of margins you see in technology. So technology and pharma, to me, they have similarities in the way that they make money. And these guys are making a lot of money. Here, is this going to give me my free cash flow in dollars? So free cash flow is $10.75 billion in free cash flow. I really like this business. I would probably multiply this times 30, get to about $300 billion minus debt. And their debt is about 10 billion. So maybe about 290 billion in market cap, and they're at 394. So they're priced a little expensive. Now, this is an exciting company that's really run up their stock. So I have other choices within healthcare that I think give me a better value proposition. And I'm going to go there because this is a terrific company. It's a good stock, pays a dividend, but I think I could do better. I think I'm going to do better with Pfizer, United Therapeutics, Catalyst Pharma. What's the other one that I just started buying is Halo. So there's good choices in healthcare. This one does have a 22 PE, but we saw United Therapeutics was like 14 or 12. You look at some other healthcare companies that have similar margins, and you can get them for PEs at like 12, 14, which show that, hey, you're just getting a better fundamental there. So I'm going to pass on Novo Nordisk. I think it's a terrific company, but I just have better choices in healthcare. So somebody asked about insurance. Insurance businesses have been terrific, and I think they're going to do well going forward. So RTO, Rentokil Initial, together with its subs, provides route-based services in North America, the UK, and the rest of Europe. So these guys do pest control. Okay. Wow, a lot of employees. Rodent kill. Okay. All right. 11 billion, $6.8 billion of revenue. 1 year down, 5 year down. They're growing. That's good. Margins, really good gross margins. Interesting. Cash is 542. They've been growing it, very consistent. So 542, good margins, good growth. Maybe they're 10 billion minus debt, maybe 15 billion minus debt. And their debt is 4 billion. So they're worth 6 billion to 11 billion. So they're priced fairly if you're optimistic about their business, and they're priced at a premium if you're like, well, it's going to do okay. I think the rodent business is going to be consistent, right? You're not going to like stop protecting your property from rodents. So I get that, but it's just priced really high, and they have a lot of employees. I'm amazed that they have those kind of margins. Yeah, their gross margin, I guess. See, but I'm kind of surprised because as part of, the service, you're paying somebody to go out there and take care of, service the property, and gross margin should include direct materials, direct labor, and direct overhead. And in my book, direct labor is the person you hired, goes out there and takes care of, that property, sprays or whatever they do. And it seems like they're not adding that number, because once you get down to a net profit, the profit really shrinks. Net profit is only 7%. So this one here is a pass for me. It hasn't gone anywhere, and I don't know that it's going to go anywhere. Next company is Lumen. Lumen does communication services, and boy, their stock really suffered. They used to be a $15 stock. They got down to $1, and now they're $5. So I'm sure the people that bought here are like, oh man, that was a genius move. It was. You 5x'd your money. But it was just a high risk move because these guys, I think they have a lot of debt. So market cap's 5 billion, revenue 13 billion. The revenue's been contracting quarterly, smaller contraction. Looks good. Looks better, excuse me. So I think they've been selling off parts of their business to try to survive. And when we look at balance sheet, so they have $17 billion of debt. And the market cap's 5 billion. So it's really hard to invest in a business like that. That's a lot of debt. It's a risky situation because that's a lot of debt. And I'm going to show you a couple of things. So debt to EBITDA is 5. It's a lot of debt. When we look at their financials, what's their interest expense? So interest expense. So interest expense is $1.3 billion. It's 10% of the gross. They're paying in interest. 10% of the money that they gross is going to interest. And if we look at so it's just, man, it's a bad situation. So obviously, because the stock price really went down to $1, it seems like they're going to make it, which is good. This is not my cup of tea. I'll leave it up to other investors to kind of see if these guys are going to make it. But I hope they make it. I hope they make it and keep employing their employees. Good luck with the stock. I don't have a value because the numbers are very negative. And one of the deal breakers for me is that debt. If you have debt more than 3 times debt to EBITDA, I'm kind of out. It's just too risky. I don't want it. I don't want that kind of debt level. HAFN. Hafnia. So it's up a little bit today. Year to date, it's down 20%. For the 1 year, it's down 16%. Has a humongous dividend. $2 billion market cap. These guys operate oil tankers. So that low oil price, right? That means that there's not a lot of demand. So if you don't have a lot of demand, you're not going to need to ship product around the world. If you have a higher oil price, there's probably signifies that there's higher demand. So I would think that, hey, low oil price equals lower demand. These guys are not going to make as much revenue. They had a drop in revenue of 54%. Holy smokes, in the last quarter. So just on fundamentals, I mean, I'm out. I'd rather buy Zim. I'm looking to buy Zim stock at like $16.50 or something. I don't know if it's going to get there, but that's the stock that I'm tracking. That's a shipping stock. This one here is not my cup of tea. Just the fundamentals are not making me comfortable. That revenue loss kind of freaks me out. And free cash flow looks good. Almost $1 billion. Almost $1 billion of free cash. And they're a $2 billion company. But that's $1 billion in the rear view mirror. What are they going to do going forward, right? You had that collapse in revenue. Man, that's kind of a little bit scary to me, man. These guys should have debt because they buy these ships and they have to borrow money to pay for the ships. They have about $1 billion of debt. That's not too bad. That's not too bad. Let's see, debt to EBITDA of 1.13. Yeah. So if you think these guys are going to grow, then you might be onto something, but the market doesn't think they're going to grow. In the 1 year, it's contracting or depreciating in stock price. Over the 5 year, I mean, this was a good move. And the dividend, I would double check to see, is the dividend something they can afford? So the payout ratio is 77%. You had a 54% decrease in revenue. So I would be super surprised if they can keep that dividend. I would think that they have to chop it to some extent. So, yeah. So I'm going to pass on HAFN for shipping. I'll go to Zim. ZAL. Whoa. Got a lot of options here. So ZAL. So I think this was the stock that was being asked about. So these guys do online platform for fashion and lifestyle products. The company operates through Fashion Store. It's a German company. Okay. So a non-store retailer. So they're kind of an e-commerce play. 8.5 billion in market cap. The 1 year up 67%. Year to date flat. 5 year down. Interesting. Revenue is 10.57 billion. And this is in the euro. Euro is like 1-to-1 right now. So that'll be cool. PE ratio 33. So not a big grower. Interesting that they're not growing. I mean, it's in an interesting category, right? The industry does seem interesting, but they're not growing. Their growth is accelerating. That's good. So single digit growth that is accelerating. That looks good. Free cash flow is 533. Okay. And they have more cash than debt. Very good. Almost $1 billion of cash. So these guys are if you believe they're going to grow, they're probably worth $10 billion. And if you think they're going to be a slow growth, no growth, like company, they're worth maybe $5 billion. And they're at 8.5. So they're kind of in the middle. Now, this is in Germany. I don't understand Germany as well enough. So I'd actually have to increase my rate of return that I want because I'm taking a higher risk just because I don't understand it as well. So I'd actually be a pass on this. It's just not obviously a huge opportunity and it's too much risk for me. as here in the US. If you're in Germany, you understand these guys and you're like, hey, this business is really interesting and it's going to grow and it's actually going to do awesome things. You may be onto something. It's working for the 1 year. It's flat for year to date. So kind of like the ball is in the court of the investor, maybe that is located in Germany, that can look at this stock and make a very good decision. Thanks for asking. BBAI. Oh, Big Bear. Yeah, these guys, man. Hoo-hoo. Talk about, you want a wild ride? You invest in Big Bear AI. We will take your money and we will triple it. And then we will chop it up into thirds and give you your money, your original investment back. And you probably developed a smoking habit because you were chain smoking cigarettes when it got to this high and it started to sell off. And hopefully investors sold somewhere around here. When we look at the fundamentals, there really aren't any fundamentals to look at. This is an $854 million revenue company. They do AI, they do some type of AI app. And really it's the hype. They're not growing and they're really tiny. You should be growing if your product's like really successful and customers love it. Even though it's a small revenue number, they lose a ton of money. That's not good. And no free cash flow. They're burning cash. That's not good. So they're losing money and burning cash. And they have $140 million of debt. So good luck. I don't know if they're going to be around forever. Look at that chart. Woohoo. Yeah, this one's a total pass for me. And we've been looking at this stock a few times, probably over the last 2 months. And each time it's like, wow. It's like watching a train wreck. But that's where this stock is at, man. It's really selling off. I wouldn't touch it. ABG. Okay, I'm looking at like 4 different businesses. Well, we want to see Avgo, I think. Broadcom. That's what I forgot to put the O. So Broadcom's up 5%. It was up 14% after announced earnings. Now I'm going to pull their blankets. This is an $888 billion market cap company, revenue of $54 billion. And when we look at their financials, you're seeing these growth rates. It really jumped up. And the growth, the jump in growth was because they acquired a software business, VMware, and it added a lot of revenue. I think it's a good acquisition, but it's not organic. So that's one thing. And they have a lot of debt because they acquired that business. Their gross profit's okay. It's good gross profit. This is one of those, these are a quality business. I used to be an investor, but they're just priced too high. Their free cash flow looks really terrific. And you'd have to multiply free cash times 44 to get to their market cap. That's too much because this is not organic growth. If you look at organic growth for these guys, it's more like 10, 15%. And that's what's going to start to show up when you make a turn, when you lap your numbers to see how the growth rate is beginning to come down. Once you lap these numbers and, this is Q1, once you get into like Q3, Q4, you're going to see this number come down to like 10, 15%. And it'll be like, oh, okay, it was that acquisition that had a big step up in revenue. But organically, they're not growing that much. Now, the data center has been a hot spot for them. They've grown really nice, but I think that's going to slow down. I mean, the writing's on the wall. The data center is going to slow down a bit. So this one here, it's having a good day. It's having a horrible last 45 days or so. Let's take a look at the stock on this charting tool. We look at from that date to now, it's down 22% from January 24th. That might have been their all-time high. So yeah, it's having a good day, but a horrible month and 2 weeks. So 6 weeks, I guess. So really bad 6 weeks. And I just expect this stock after today. What's the market doing? The market's up a little bit. So we're having a green day. This had a really red day yesterday. If we look at the 5-day, it's down 7%. So anyway I look at it, I think Broadcom is priced too high. And let me take a look at. I was curious to see, because when I saw the headlines last night, up 14%, up 15%, I'm like, okay, I'm not believing it. NVIDIA went from, if you remember the earnings announcement on NVIDIA, it's like they announced and it went down 3%. In the same evening, it went up 4%, down, up. The market didn't know what to do. Then it opened, then it sold off. And it's like, that's insane. The earnings were really good. These earnings were okay. They were okay. And I think the stock price, if you look at free cash flows, it's priced 49% too high. If I look at overall, include earnings per share, it's priced 36% too high. And I went from being a Broadcom investor. I invested, made money, got out. I invested when the business was worth like 200 billion. Now they're like at 844. It's like, yeah, I'm not going to be a buyer of that business. So we'll see. I would not be surprised if Avgo goes negative today. If it goes to a negative number today. And I think it's going to continue to fall. So that is Broadcom. All right, man. We just covered 21 stocks. Man. You guys put me through the paces today. A lot of interest in stock investing, making money long term. Somebody asked about Robinhood. Let's make this 22 real quick. That's not too bad. All right. No need to give me a heart attack. I like Robinhood. All right. So Tomas, you want to look at Upwork? Let's take a look at Upwork. So Upwork is up today. Upwork is like the gig economy. You can find like temporary assignments on it. Year to date hasn't been working. I think this is a good opportunity. $2 billion market cap, tiny. Revenue is good. Forward P 13. When I look at the revenue growth, this is a good growing company. Quarterly had a pullback, but the revenue growth has been good. And when we look at let's take a look at their margins, gross margins of 77%. They're already profitable. They're already creating, free cash flow. As we go into this economy that we're beginning to go into, and somebody loses their job, maybe a federal employee, and they're like, well, maybe I want to go on Upwork, do a couple gigs, stay busy, collecting unemployment. People are going to look for ways to make some money and kind of get through what potentially is going to be a recession. Upwork, I believe, is going to be a recession-proof stock. It actually is going to thrive. Airbnb thrived during the last recession because homeowners were like, well, I don't want to lose my home. So they started renting out bedrooms, part of their homes, turned their homes into bed and breakfast. And it really worked. And everybody won. Homeowners kept their homes. Airbnb made money. The consumer was happy because they're like, hey, I'm traveling to New York City and I can spend $500 a night, or I can go rent a bedroom from Joe Smith and pay $100. I just saved $400. And that is not an exaggeration. I'm traveling and I'm going to be staying at an Airbnb, awesome little Airbnb. Square footage that I'm going to get is going to be probably about 800 square feet. And it's going to come at half the price tag of a hotel that is a half a mile away from where I'm staying. That's what you get when you go to Airbnb. Upwork is similar. If you have the working population have adversity, which is, oh no, fewer jobs, man, put yourself on Upwork. Get a couple gigs throughout the year, make ends meet, you'll be good to go. So this is the Uber of gigs. This is the Airbnb of gigs. I like these kinds of businesses. I really do. So I'm a big Uber owner of stock, big Airbnb owner stock, and I'm buying into Upwork. I like Upwork. So when we look at Upwork, I think it's discounted profoundly by 68%. I'm good to go. I'll keep buying into Upwork. I like the business. I like everything about them. They're being sold off because they're a small cap. The market doesn't like to buy small caps when things get scary. When things get scary in the market, it says, no, Russell, like we're going to look at this and then I'll look at the Russell. So this thing's been kind of selling off because the market's like, no, I'm scared. When I'm scared, I sell off small caps. I sell off small caps to a greater portion than I do the NASDAQ. Okay. And that's what's happening is small caps are selling off because there's fear in the market. Well, fear is going to discount stocks and I want to own more Upwork. So I will gladly pay to buy Upwork and load up on some shares. Now, I'm not going to buy a tremendous amount. Now, a young investor looking at Upwork, I like young investors to look at stocks like this. Because if this puppy works and it ends up being worth 50 billion in market cap, you take that $1,000 and you multiply it times 25. You take that $10,000, you multiply it times 25. Now we've got $250,000. So Upwork, if this business works and it establishes just a great growth trend, it becomes a $50 billion market cap company over the next 5 years. Great payout, great wealth creation, wealth expander, wealth multiplier. This is a good stock for a young investor that wants to take chances, risks, because they want to find Uber when it was $2 billion market cap, because now it's like 100 billion or however many billions it is. So those are my thoughts there, Tomas. I'm glad to provide anything else you need. And let me just double check here. So it looks like that's all I'm going to be able to cover, guys. And really appreciate you joining my live stream. And over the next couple weeks, I'm probably going to have a lighter schedule. I'm not going to be able to live stream as much, if at all, for the next 2 weeks. So just be aware. If you don't see me, it's because I'm not able to live stream, but it was nice to check in with you. Let's take a look at the markets real quick. What the heck happened? I turned away for a second and then the S&P goes negative. Somebody's got to keep an eye on these guys. The Russell's there. Broadcom's still up. All right. Well, this is telling me that the market may sell. Oh, here now we're in red. Man, what the heck, stock market? When are you going to stop selling off? You drive me. Yeah, Mike, thanks for coming back and good luck today. I was just kind of wrapping things up. So we're now in the negative here. I don't know that it's. Let's see what's selling off and what's green. All right, Nvidia's up a little bit. Eli Lilly is down. Walmart's down. Costco. Wow, Costco's down. Oof. Palantir's up. Uber's up. Adobe's up. Good to see Adobe's up. Nice. Cool, man. Well, here we are. We're in 2025. Stocks are selling off. And, just continue to become better every month. And I know that it stinks if you own Eli Lilly and it's down 2% today. It doesn't feel good. Let's not pretend that it ever does feel good when your stocks goes down. But over time, I could tell you that when markets correct, they're doing everybody a favor. And I don't think investors of like AppLovin as an example that went down 49%. That's a rude awakening, and it's a big loss of capital, loss of wealth, and so forth. So if you have too many stocks like that, it just the stock market becomes kind of a landmine. God knows which stock you're going to buy, and it's going to go down by 50% over the 2 to 4 weeks. So this correction kind of sweeps for all those landmines and kind of gets rid of them. There'll still be a couple, but not as many. And it also reduces great businesses, gives us a better price to buy into it. We covered a couple that are superb, like Meta and Upwork. So it's a good thing to have a correction in the market, have some stocks sell off. And that's my live stream for today. Thanks so much for tuning in. Remember, this is always just one investor sharing experiences, sharing opinions. It's never financial advice. I don't recommend you buy, hold, or sell any stock I covered, and I don't ever recommend it. I wish you the best of success in investing. Let's close out the week, see what we got next week. And I think the employment report was supposed to come out. I'll have to read that after my live stream, see what's going on. All right, everybody. I really appreciate you. Enjoy the weekend as well. Have some fun. And let's get back into it next week. Again, I won't be live streaming probably at all next week and probably the week following, but I'll get back as soon as I can. I'll produce a couple of videos, probably not as many as I usually do, just because the next 2 weeks, I got other stuff going on. All right, everybody. You guys take care, and I appreciate you tuning in.